Hello, my fellow investors. In this video, I'll get into crunching the numbers of Thor in the past 20 to 30 years. So I started off in 1993. This was 13 years after Thor got incorporated. They got incorporated in 1980. That's when they acquired Airstream. So I couldn't get data from before this. Even 1993, I couldn't get the data for this year because the first annual report, which was on the company's website, was from 1994. 1995 actually, so that was also 1 year before. And then 1993 they didn't have any annual report, but I did get this data from a report later on, which some of the data was in 1995 annual report, some of them I got from different reports, so I couldn't get all the data for 1993. But from 1994 and on, I have all the data. So before I get into the numbers, I just want to explain why I'm interested in companies like Thor. So I'm not looking to do fancy investments. I'm not looking to do these crazy investments, doing all this intrinsic value and calculating the future and buying at a high PA ratio. I'm looking to buy a company that has an average of 10% growth a year, and it's a good company. The return on assets are good. Everything is good. It's managed good. And besides that, I'm buying it at a PE of 5 or less. So if I'm buying a company at a PE of 5 or less, I'm earning 20% a year. And if it's growing at a 10% rate each year, that means that in 7 years, I'll be earning 40% of my investment. And in 14, 15 years, I'll be earning 80% of my investment annually. So I'm not looking to do these crazy investments. It's out of my circle of confidence. I don't know how to calculate the future. I don't know how to predict the future. I'm not so good at that. I'm just doing the past. If I see for the past 20 years, the company is doing very good. It's a good company. It's managed well. It's growing 10% a year. If I get it under 5 PE, for me, it's a good buy. If it's a good company, if it's in my circle of confidence. So let's just look at the numbers over here. So they had the net revenue in 1993 was $11 million. $16 million is growing every year. Over here you could see the growth in between each, for how much it grew from the year before. 1999, $30 million. 2036, a 17% growth. So over here we had the crash, the dot-com crash, so things are going down. Then we have 91% growth. It's growing almost every single year, besides bad years, as Thor is a highly cyclical company. People don't tend to buy expensive stuff like RVs and when there's financial crisis. So we start off at 30 years ago at $11 million annual net revenue, and in 2002, the $1.1 billion. You can make the calculation on from 11 million to 1.1 billion. That's a nice growth in 30 years. And another thing we can see is the net margin. So the company isn't only growing, but also the margins are growing each year. So in 1993, their net margin was 2.8%. So that means out of the $412 million they sold, the top line, the net margins after everything was 2.8%, and it's growing every year, 3%, 3.8, 4, and then every time it comes a financial crash, it goes down. But we see it constantly growing, 4, 5, 4.7. So here again we get to 2008, so it's going down. 4.8, 3.6, 4.6, 4.7, 5, 4.98, 5.6, 5.16. And then again, this is COVID, everything goes down. 2021, 5.5, and in 2022, it's already almost 7% net margins. So that's also a very nice thing I like in Thor. They're managed very good. They're making their company better and better. Sorry. Now, before I get to the main part of this video, I just want to do the return on assets and return on invested capital. So the way I calculate return on assets, I do the net revenue divided to the net tangible assets. So we can see over here also the return on assets. So this is 2000, this is 1994, 14%, 13, 13, 9, 14, 16, 17, 18, 19, 15, 11, 13. So also we have here a consistent average of return on assets. I'll show you some of the average for all these years. 25%. So here again we have getting the bad years, it's going down. 27% in the last year. And what I like to calculate also is what I call the revenue growth return on capital expenditure. So I'll explain to you what I do. Every year I'll put inside the number of how much money the company earned more than last year. So I call this revenue growth. So in 2015 the company earned 199 million. In 2016 they earned 256. So the company earned in 2016 $57 million more than they earned the year before. This I'll call the revenue growth. How much money the company earned 1 year more than the prior year. And how much was the capital expenditures the last year? 42 million. So in 2015, the company invested 42 million in the capital expenditure. The year after that, their revenue growth was 57 million. That's more than they invested the last year in the capital expenditure. Now, capital expenditure could be through the whole year. So I'll just like to take last year's capital expenditure, the next year's growth in revenue. So I just calculate. I call it the revenue growth return on capital expenditure. So it's the revenue growth return on capital expenditure. So this also shows us how little capital Thor needs for its capital expenditure to growing. So in this year they had a 232% return on last year's. That means in 1994 they earned 232% more money that they invested last year in the capital expenditure. So if you hear this is data I don't have, and I didn't put it in. 72%. So the bad years it goes down. 142, 300%, 100%, 58%. So this also, I think, the reason why Warren Buffett bought Forrest River. Forrest River is one of the biggest RV companies in the world. That's I think it's the second largest company in the United States after Thor. And we know Buffett doesn't invest in all kind of industries, which he doesn't like the industry. And if Buffett bought Forrest River, Berkshire bought Forrest River, it means that first of all that Buffett likes this industry. And I can understand only by looking at this number why he likes it. We can see that the company doesn't need to invest a lot of capital expenditure to continue its growth. And we can see it's amazing numbers. I'm not saying it's better than other companies, I'm just saying the company, let's say this year was 2017. So the company earned more than double the money they invested last year in capital expenditures. So I did return on assets. I showed you very nice return on assets and return on invested capital. So the way I calculate return on invested capital, so I'll do the net revenue. This is the net revenue divided to return on invested capital. So the return on invested capital, I'll take the shareholders' equity, which is the equity minus the liabilities, and I'll add on the investment, the debt. So it's a shareholders' equity plus the debt that I'll call the total investment, and I'll do the net revenue return on the total investment, which is the shareholders' equity and the investment. So we see also great numbers. These numbers could be maybe totally different than what you'll find on different websites like, I don't know, QuickFS or something else, or MSN. So also 17%, 19, 19, 12, 15, 19, 21, 20, 23, 18, 13. These are the bad years, 13, 14, 17, 18, 19. So we can see the way I calculate return on investment, the company has 15 to 20% return on investment annually. So I like Thor as a company. I think it's managed very good. In the next video, I'll get into the whole story behind Thor and the management and everything that's going behind it. But basically what we can see here is a company has a consistent growth. In the last 30 years, it didn't have officially any year that they lost money. The return on assets is very nice. The return on invested capital is very good. And so basically what I'm looking to find out, and that's the main reason I'm doing all these numbers. I'll probably say this in every video I put out on these kind of numbers, these kind of videos. I don't invest basically only by analyzing data. I call it paper analysis. I invest by understanding a company. The numbers just help me understand the company. So all this data from the last 30 years, basically I want to do is this part. This for me is the real picture of the company. So what I want to do is I want to get the the compound annual growth rate for all the years. So if we'll just take 1 year and we'll do how much was the CAGR for the last 15 to 20 or 30 years, it wouldn't give us a very good understanding of the company, because maybe exactly the last year was very high and the first year we started off the calculation was very, very low. So that's why I do all different kind of years and then I'll average it up. So I'll do like this. So this is the compound annual growth in 10 years from 2012 to 2021. So here, the revenue, the top line was 16%. That's the average growth rate in the last 10 years, from 2012 to 2021. And over here, the net revenue, 18%. And now we'll go 20 years, from 2002 to 2021. So it's 12%. I didn't do the calculations for 2022. Gross margin, 13%, and the net revenue was 13%. So you see over here, the 20 years is lower than the 10 years. It's always, in 20 years, you have at least another recession, so we'll take down the average. But 20 years also, maybe exactly that year it started off. 2002 was after the dot-com crash. Maybe that year was very low, and the last year was very high. So it wouldn't give us an accurate understanding how much is the average company's growth. So what I do is I do like this. So first of all, here's also the 30 years. From 1993 to 2022, their net revenue was up 60%. So that means we have here a data for 30 years, going back 30 years. Their average growth net revenue is 16.4%. And in the 29 years from 1994 to 2021, it was 15.8%. Now here's the thing that I really like to do. It's taking the average of full of years. So what I do is I'll do the CAGR for 15 years for full of different time frames, and then I'll average all those frames together, all those time frames together. So here we have 15 years from 1993 to 2015. So the net revenue was up 20%. Their average compound annual growth from the 15 years from 1993 to 2015 was 20%. And then the next 15 years, from 1994 to 2016, 20%. From 1999 to 2013, 11%. So you see how this is almost half of what it was the prior averages. These are bad years, 1999 and 2013. So we're going exactly into financial crisis, the .com and the financial crisis of the housing market. So that's why the average was way down. Again, 2000 and 2014, 10%. 2001 and 2015, 8%. 22 and 2016, 11%, 10%, 9%. And these are really bad years. Minus 3% and 5% and 14%. 18%. So this is the number I'm looking for. All this data is basically just to get this number. How much is the average? What I did over here in this number, this is the average of all the compound annual growth is average of all these. So I'm averaging this 15 years and this 15 years and this 15 years and this 15 years. All these 15 years I'm putting in and averaging it. So it gives me an average. This is probably the most exact number to understand what's the average annual growth rate of Thor, which is 11.5%. So of course there'll be better years and there'll be worse years. Well, we could pretty much say this company is pretty much in the last 30 years is pretty much a sure conclusion that it will grow an average of plus 10% for the next I don't know, for the next future. Over here, what's we see? 10%, 11%, and 10%. So it doesn't mean they'll grow only 10%. I'm saying this is pretty much like a for sure. Unless something bad happens to the company, this is pretty much a easy conclusion to say this company is growing. Any time you go into the company and you're going to hold the company for 15 years, you'll probably have a growth of 10% each year. A compound annual growth of 10%. No matter what time you go into the company, in the bad times or good times, you'll probably get in the next 15 years a average compound annual growth of 10+%. So I also did other calculations, but this is shareholders' equity. So the past years, this is tangible equity, which is bad because when they acquired the Owen Hyman Group in 2019, their equity, the net tangible equity went down very much because they took on so much debt to buy the Irwin Hyman Group. So the net tangible assets was in a minus in these 2 years. So over here we get the averages are problematic. But basically this is like all this data I'm putting in just to get this number. How much is pretty much a foregone conclusion that this company, no matter what time and when you get into the company, you get an average of 10% growth per year. So I'll basically conclude my video. I like Thor. For me as a company, it's a company which has an average of 10% growth a year and higher. And if I could get in a good price, I'm willing to buy it. I'm not saying this is the best company in the world. Some people would like much more profitable companies, and this is a very cyclical company. If we're going now into recession, I might be able to buy this company in a very, very good price. Thank you very much, and hope you enjoyed this video.